The dividends received deduction, or DRD, is a C corporation's break for receiving dividends from another corporation. It's trying to reduce tax on tax on tax. Without DRD, the paying corporation is taxed on earnings, then the corporate shareholder is taxed on dividends, and then owners of that shareholder can be taxed again. On the EA exam, they'll test the purpose and then make you compute the taxable income impact. Your first job is picking the right DRD percentage. It's based on how much stock the receiving corporation owns in the paying corporation. Less than 20% ownership gets a 50% deduction. From 20% up to 80% gets 65%, and greater than 80% ownership gets 100%. Exam tip: don't round ownership up. 19.9% is still less than 20. Now apply it. The DRD is a percentage of the dividends received. So if you receive $50,000 of qualifying dividends and your ownership level gives you 50%, the DRD is $25,000. Notice what that means. You don't exclude the dividend from income. You include the dividend, then take a deduction. On the exam, that ordering matters because they'll ask for taxable income after DRD. Let's run the taxable income math using the classic setup. Lauder has taxable income of $70,000 before considering dividend income. It receives $50,000 of dividends and owns 10%, so it gets the 50% DRD. Step 1. Add the dividend to income. $70,000 plus $50,000 equals $120,000. Step 2. Subtract the DRD. $50,000 times 50% is $25,000. Final taxable income is $95,000. A quick way to sanity check your answer is to compute the taxable portion of the dividend. With a 50% DRD, half the dividend is taxable. So $50,000 dividend becomes $25,000 net taxable dividend. Add that to the $70,000 base income, and you land at $95,000 again. On the EA exam, this shortcut helps when they hide the DRD inside a longer taxable income problem. Which of the following is not considered a related party to a corporation, and therefore not subject to the restrictions on related party transactions? The choices include a corporation in the same controlled group, an employee shareholder of a personal service corporation regardless of stock owned, an individual who indirectly owns at least 25% of the corporation, and a trust fiduciary when the trust or grantor owns more than 50%. Think about it. The correct answer is the individual who indirectly owns at least 25%. That's the tempting one because 25% sounds significant. But for these related party rules, the key ownership trigger is generally more than 50% direct or indirect ownership. The controlled group and the personal service corporation employee shareholder are specifically treated as related parties, and the trust fiduciary rule uses the over 50% ownership threshold. Harborview Financial Group is a cash-basis C corporation. It distributes property in a non-liquidating distribution to a shareholder. The property has a fair market value of $120,000 and a basis of $72,000. How much gain or loss does Harborview recognize? The options include no gain or loss, a $48,000 gain, a $48,000 loss, or a $72,000 gain. Think about it. The correct answer is a $48,000 gain. In a non-liquidating distribution, a C corporation recognizes gain on appreciated property as if it sold the property for fair market value, but it generally does not recognize a loss on depreciated property. Here it's appreciated, so gain is FMV minus basis. $120,000 minus $72,000 equals $48,000. The zero answer is tempting if you confuse it with some shareholder level rules.